On February 13th, Eastern silver touched $75 after collapsing more than 10% in a single week. By the close, it clawed its way back and stabilized near $77, and almost instantly, the narrative split in two. Some voices screamed manipulation, others said this was the beginning of a larger crash. But what the data actually shows is something far more important and far more strategic. This wasn't chaos, it was structural liquidation. And that distinction changes everything, because structural liquidation doesn't happen randomly. It doesn't happen because of conspiracy threads, and it doesn't happen because retail traders panic. It happens when leverage gets unwound at scale. It happens when institutions rebalance risk. It happens when forced selling meets a tightening liquidity environment, and that is exactly what unfolded during this 10.5% drop. Silver fell from the low 80s into the mid-70s in days. The speed of the move created fear. But when you zoom out, something critical stands out. Price held above major technical support near $73.86 and quickly reclaimed $77. That's not collapse behavior. That's controlled repositioning. Meanwhile, physical demand hasn't disappeared. The Silver Institute is projecting a sixth consecutive annual deficit in 2026. Perth Mint reported 1.72 million ounces sold in January before pausing orders due to backlog. Retail premiums remain elevated, so if supply is tight and deficits persist, why did price fall 10%? Because paper markets move first. Because leveraged players get squeezed before physical buyers react. Because structural liquidation is mechanical, not emotional. And here's what almost nobody is explaining clearly. When liquidation is structural, not systemic, it often resets positioning before the next move higher. But to understand whether $77 is stabilization or simply a pause before another leg down, you need to understand what structural liquidation actually means and why it matters to your portfolio. If you own silver, physical or paper, this matters directly to you. Because a 10% weekly drop feels like danger. It feels like breakdown. It triggers memories of 2008, of 2020, of moments when volatility turned into collapse. But those events had a different fingerprint. In 2008, silver collapsed alongside everything because the entire financial system was seizing. In March 2020, liquidity vanished globally and forced liquidation hit all asset classes simultaneously. This time, we've seen one bank failure reported in early 2026. The Federal Reserve balance sheet ticked up by $16 billion to $662 trillion. Discount window borrowing increased modestly. That's stress, but not systemic panic. At the same time, the gold-silver ratio is hovering near 65.2. Historically, ratios above 60 signal silver is relatively undervalued compared to gold. Silver is still up roughly 140% year over year, even after falling 36% from the January 2026 all-time high of £121.67. So what does that mean for you? It means volatility is compressing excess leverage, not necessarily destroying the long-term thesis. But here's the conflict forming beneath the surface. Industrial demand is projected to dip 2% to around 650 million ounces in 2026, yet investment demand is expected to remain strong, offsetting that decline. That creates tension between growth expectations and monetary hedging demand. China's central bank has signaled continued supportive policy. India imported $9.2 billion worth of silver in 2025. Solar and EV trends remain intact, so while price corrected sharply, structural demand drivers remain. And that's where the real question emerges. If liquidation was mechanical, who was forced to sell? And who is quietly absorbing supply at 77? Because markets don't just fall, they transfer ownership. And here's who's responsible for setting the tone of that transfer. When volatility spikes in silver, one name always surfaces: JP Morgan. Not because of rumor, but because of history. JP Morgan has long been one of the dominant participants in precious metals derivatives. It holds significant influence in futures positioning and has historically been accused, and in past cases fined, for metals market misconduct. Recently, JP Morgan analysts warned silver could revisit $50 under certain macro conditions. Yet in other forecasts, the bank projects an average price around $81 for 2026. That divergence tells you something important. Large institutions operate in probabilities, not narratives. Banks hedge exposure. They short futures while holding physical. They manage books that retail investors never see. Meanwhile, the Federal Reserve is continuing quantitative tightening. Liquidity is not expanding aggressively. Higher rates mean leverage becomes more expensive. When leverage gets expensive, marginal players unwind. That unwind is structural liquidation. Not coordinated manipulation, not conspiracy. Mechanics. Futures markets are margin-based. When volatility increases, margin requirements rise. Traders with leveraged long positions must either post more capital or sell. CME has previously increased precious metals margins during volatility spikes. That forces selling pressure even if fundamentals remain intact. So the villain isn't a single bank, it's leverage interacting with tighter liquidity. And that dynamic has played out before. To see it clearly, we have to go back. In 1980, silver spiked violently as the Hunt brothers attempted to corner the market. When margin requirements changed, forced liquidation crushed price. In 2011, silver surged near $50. Then margin hikes and deleveraging triggered a rapid collapse. In 2020, silver dropped below $12 during pandemic panic before rallying aggressively as liquidity returned. In each case, leverage amplified moves up and down. The pattern is consistent. Excess positioning builds. Catalyst hits. Margins adjust. Liquidation cascades. Strong hands accumulate. The difference between collapse and reset is systemic risk. In 2008, banks were failing across the board. Today, we've seen isolated stress, but not cascading institutional failure. Silver at $77 after a 10% drop resembles consolidation after leverage flush, not financial breakdown. And history shows that when structural liquidation completes, price often stabilizes near major support before choosing its next trend. Which brings us to the data, because speculation ends where numbers begin. Let's look at the hard facts. Silver spot recently stabilized near $77.32 after falling to $75, a 10.5% weekly decline. Support held above $73.86. Year-to-date gains remain above 160%. The Silver Institute projects a sixth consecutive annual market deficit in 2026. Investment demand is forecast to rise roughly 20% to 227 million ounces. Industrial demand dips slightly, 2%, but remains historically elevated around 650 million ounces. Perth Mint sold 1.72 million ounces in January before pausing new orders due to backlog. Physical premiums average around $558 above spot. The Federal Reserve balance sheet stands at $6.62 trillion, up modestly by $16 billion. Gold-silver ratio near 65 suggests silver remains discounted relative to gold. Now here's what they're not telling you. A 10% drop feels dramatic, but volatility clusters near major highs are normal. Silver peaked at 121.67 in January. A 36% correction from an all-time high is painful, but historically common in metals bull cycles. Now here's what they're not telling you. If liquidation were systemic, premiums would collapse. Instead, retail demand remains firm. Now here's what they're not telling you. If this were manipulation alone, we wouldn't see consistent physical deficits across 6 consecutive years. The data doesn't show breakdown. It shows leverage reset. So what happens next? If you miss 3 signals in the next 60 days, liquidity shifts, margin adjustments, and institutional positioning changes, you risk misreading the next major move. Here's the roadmap. Watch Federal Reserve balance sheet changes. Monitor margin requirement updates. Track gold-silver ratio direction. If liquidity stabilizes and leverage remains controlled, silver could consolidate between $73 and $85 before retesting higher resistance. If stress escalates, bank failures increase, credit tightens aggressively, volatility could retest lows. Experts broadly agree on one thing: deficits persist. Volatility remains elevated. Leverage is the accelerant. The margin for error is shrinking. The reason now matters is timing. After a 10% drop, weak hands are gone. Ownership shifts. Structural liquidation resets markets. You are not powerless. Focus on risk hygiene. Avoid excessive leverage. Track primary data, not headlines. Silver holding $77 after a 10% drop is not a headline about collapse. It's a test of conviction. And the next move will not be driven by emotion, but by liquidity. Stay disciplined, stay informed, and watch the data, not the noise.